Welcome to our conversation on financial reporting. In this session, we will revisit the financial statements with a focus on observing the interrelationship between the financial statements. For that, we'll take a simple example. We would like to observe when we say financial statement, balance sheet, income statement, cash flow statement, and the statement of changes in the equity. To understand that, we will pick up a simple example of a set of transaction. This is an hypothetical company called ABC. The opening balance sheet is given here, which can be called as a closing balance sheet on 31st March 2024, which is the opening balance sheet for the year 24-25. So we can see that the balance sheet has equity and liabilities showing equity, non-current liabilities, current liabilities, similarly non-current assets and current assets. And a set of transactions are given, and we would like to convert these transactions into financial statements using the generally accepted accounting principles. And while doing that, we will observe that interrelationship. Let us convert this information into Excel. Let us go to the Excel. So this is the opening balance sheet given. Equity 1.02 million. The non-current liability 250,000. Current liability 20,000. Supported by the non-current assets 300,000 and current asset 990,000. So therefore, assets are equal to the sources, and sources are equity plus liability. With this information, we can also derive some additional information that is called the book value per share. The book value per share is the equity per share, and equity per share is also known as the asset backup per share. So at this juncture, equity is equal to 1.02 million. We can see that. And the number of shares is 125,000 because the capital is 250, face value is 2. So the number of shares is capital divided by the face value per share. So observe that the book value per share is 8.6. That means if the company is closed today and the market value of assets will be equal to the book value, then each share, the shareholder will get 8 rupees 16 paisa per share. Now let us observe the impact of these transactions on the financial statement. The first transaction is sold goods for 50% of the goods for 12 lakh, okay, 1.2 million. So this is a sales, is an income, okay, and that is 12 lakh, okay, 12 lakh. And whenever there is a sale, you have to ask a question to yourself whether it is for cash or credit. If nothing is mentioned, we are assuming this to be a cash transaction. We are assuming that to be a cash transaction. So if it is a cash transaction, the entire sales is collected in the form of cash. So therefore, the debtors will not change during this period. Debtors is equal to opening debtors plus sales minus collections. So no change in the debtors. In the process, I would also like you to see the interrelationship between balance sheet, income statement, and cash flow statement. And suppose we assume that the sales are not collected, make it zero. We can see that the debtors have gone up to the extent of the credit sales. Okay. And whenever there is a sale, there is always a need to find out the corresponding cost of goods sold because of the matching principle. And the corresponding cost of goods sold, COGS, it says 50% of the stock available. The stock available is 760,000 into 0.50. Okay. So let me increase the font size. Okay. So 50% of the goods available, the stock available is sold off now. So to that extent, the stock becomes an expense and there is a corresponding reduction in the value of this stock. Okay, corresponding reduction in the value of the stock. So we can also see that the change in the change in the stock is equal to opening stock plus purchases minus the cost of goods sold. Okay, we can see that. And COGS is required because of the matching principle. During this period, the company has received dividend. The received dividend is an income from other sources, and the company receives dividend of 20,000. And so increase in the cash and increase in income to that extent. Rent for the period is 20,000 per month into 12 because our accounting period is 12 months because of accrual principle. But how much we are paying? Rent is paid. The current month's rent is paid at the beginning of the next month. So during this year, from April to March, by the end of the March, you only pay 11 months rent. Therefore, actual payment of rent is 20,000 into 11. You may ask a question, why is rent been shown as 20,000 into 12 despite the fact that rent paid is only 220? This is because of accrual. Every question which has a why in accounting can be addressed by referring to one of the accounting concepts. In this case, accrual principle. Expense not paid is a liability. Expense not paid is a liability. There was no liability in the beginning. The current rent is 240 and the rent paid is 220. So there is a liability to the extent of 20,000 appearing. Salaries for the period, fully paid salaries for the period. Salary paid is 30,000, 30,000 into 12, okay? And salary has been fully paid off. So therefore, there is no advance, no outstanding or no payable. Paid off creditors. During this period, the company paid off creditors. This is a payment, not an expense. And the payment is 20,000, which leads to reduction in the liability. In the process, we are also able to see that every payment is not an expense. Every payment is not an expense. This payment is a reduction of liability. Payment towards rent and salaries are towards expenses. The company paid off. For the time being, we will ignore this market value of the rent, market value of the investments. We assume that the market value of investments not given or not change. So there is no change in the value of inventory. But even if no other information there, we can, because of accrual principle, the company is bound to show interest. Interest is on bonds 0.10. And let us assume that you pay the interest. And so interest is equal to 0.10 of, okay, 0.10. And interest is assumed to be paid there. So we can also see the relationship. Interest is calculated on the bonds. Interest is an expense and a payment. Even if no information not given whether paid or not, we are assuming it has been paid. The recording has been done in the income statement because of the accrual principle. Let us also make an assumption regarding the depreciation on the property, plant, and equipment, which is a non-current asset. Let us assume that the life of the plant, okay, life of the plant is 10 years. The company follows depreciation by allocating the cost of the asset uniformly over the 10 years, okay, which is called depreciation. And this is as per the Ind AS 16. And depreciation is a reduction in the value of the asset. So depreciation is the reduction in the value of the asset. And because of the matching principle, you are bound to show depreciation in the income statement, and depreciation is by 10. We are assuming, and depreciation is not a cash item, so no effect on the cash flows, but there will be a reduction in the value of the plant, and that happens by increasing the accumulated depreciation. So by the end of this year, that means the company has recovered charge depreciation to the extent of 350,000. Okay. Since the value of amount of depreciation is 50,000, so the plant is 7 years old by the end of this year. Now we have almost all the expenses done. Okay, all expenses done. So we can find PBT. PBT is equal to income minus expenses, that is 165,000. Let us make an assumption with respect to rate of tax, 25% on PBT, and let us also pay the tax. These are all business decisions. It's not that for every item you need information. You have a freedom to make those assumptions. And these are business decisions. And this profit after tax, as per the reporting purposes, we need to show that in the statement of changes in equity. And the statement of changes equity will show opening capital, opening other equity, and other equity plus the current profit will show the closing other equity, and the closing other equity is transferred to the balance sheet. Closing other equity is transferred to the balance sheet. So we can see that link between income statement, the statement of changes in equity, and the balance sheet. Let us find the cash in hand. Cash in hand is equal to cash available minus the cash payments, the cash available minus the cash payment. So cash available is 603,750. 6,03,750. And cash in hand is an asset. Cash in hand is an asset transferred to the balance sheet. So the two important items, that is PAT and cash, which is the result of the income statement and the cash flow statement, we can see that interrelationship between these financial statements, particularly through the lens of other equity and the cash in hand. Okay. The income statement and cash flow statement and the balance sheet are interrelated and interconnected. That is what is important to observe. Don't try to prepare a financial statement only one in isolation. It's always good practice to prepare all of them together. So no change in the capital during the period. Okay. The No change in the bonds during the period. The company did not pay off bonds, did not take any more loans. Creditors have become zero. The sources, therefore, equity plus liability is 1.41 million. And no change in the investments. We assume that there is no market value given. So the non-current assets are 250 from reduced from 300,000 to 250 because of depreciation. The total current assets is 1.163 million. This is so the total assets are equal to total assets equal to the total equity plus liability. So we are able to observe the interrelationship between the financial. So the two objectives through of this exercise, first is to understand the financial reporting. Is a financial accounting is a process of converting these decisions into financial statements using generally accepted accounting principles. That's one. Number two is to observe the interrelationship between these financial statements, that these financial statements are interdependent and interconnected. That's what we are able to see. You can pick up any item and observe those three. And what happened to the book value per share? The book value per share has gone up from 8.16 rupees per share to 9.15 per share. Why did the book value per share go up? The book value per share has gone up because the equity has gone up. But why did the equity go up? Equity has increased because the other equity has gone up. Okay, no change in the capital. Equity is equal to capital plus other equity. So other equity has gone up. But why did the other equity go up? The other equity has gone up because of the profit and no dividend. Entire profit has been retained. So the increase of this book value per share, you may ask, why is book value important? Book value per share is one of the important numbers to which will help us in understanding the change in the price. Till we see the details, let us make a very broad assumption. Price depends on the book value. All other things remaining same, price and book value per share are said to be positively correlated. Higher the book value, higher the price. So management would always like to keep a watch on the book value per share. Is book value per share available on the annual report? Answer is no, because the book value per share is not a GAAP number, but book value per share is an analyst number. I strongly recommend for any company always calculate the book value per share and observe that change over a period of time and link it with the observe its relationship with the price. Invariably, you will see positive correlation. So, but in this case, you observe that we made entire profit to be retained, no dividend. So let us make this as a financial statements with no dividend, with no dividend assumption. That means the entire profit has been retained in the company. Okay, no distribution has been made. So, therefore, the PAT increases the equity. But let us assume that the company declares dividend because there is a huge amount of retained profit. So, the company, the shareholders may ask for dividend. Let us examine. So let us examine the impact of, this is what is important for us to observe. Let us examine the impact of distribution of dividend on the book value per share. Observe the book value per share is 9.15 when there is no dividend. We are keeping all other transactions same. And the company declares cash dividend. The company declares cash dividend of 100%. So can a company declare dividend here? The answer is yes, because there is reserve. There is huge amount of other equity. Can the company declare cash dividend? Answer is yes also because there is huge amount of cash. So if the dividend is distributed, all other things remaining same except the dividend distribution, and we can see that dividend distribution is a outflow of cash, is a outflow of cash. The only new item which has come up here is a distribution of dividend 100% of capital. Unless specifically mentioned, unless specifically mentioned, the dividend is always calculated on the capital 100%. If it says 100% on the nominal value of the capital, face value of the capital. So the dividend is 250%. If that happens, the cash reduces to 353 from 603 to 353. And what happens to the equity? The other equity falls because of the distribution of dividend. When other equity falls, when the total equity also reduces. When the total equity falls, all of the things remaining same, the book value per share falls. So whenever a company declares dividend, you see the book value per share fall. The reduction in the book value per share means the asset available per share falls. So you're sending a message to the shareholders that we don't need this much money, so take it back. So the company is not having any investable opportunities or opportunities for investment. So the money is given back to the shareholder. So price being the reflection of the future ability of the assets to generate cash flows, when the asset reduces, the ability to generate future cash flows also reduces. All other things remaining same or no other additional information, when the book value falls, price will also follow. Therefore, observe carefully, pick up any company, and whenever there is a distribution of dividend, observe the price before and after, assuming there is no other related decision there. So the reduction of book value is because of the distribution of cash dividend. Sometimes the companies, instead of giving cash dividend, may also give stock dividend. We'll keep the amount of dividend to be same, 250,000. So therefore, the dividend given is 1:1. What is the stock dividend 1:1? Every shareholder having one share will receive an additional share. What is stock dividend? Stock dividend is a distribution of profit in the form of stock, in the form of shares. So no change in cash, reserves will reduce, capital will go up, so no change in equity because of stock dividend. But what changes is the number of shares. Let us observe that. So the company declares stock dividend. If the company declares stock dividend in the ratio of 1:1, in the ratio of 1:1. So the number of shares are now at present, the number of shares at present is 125,000. The number of shares at present 125,000. And the company gives stock dividend, which is also called bonus shares. So the number of shares given is 1:1. So the total number of shares post distribution of dividend, stock dividend, will become 250,000. But what is the value of the dividend? The value of the dividend is the value of the capital given. So the value of the capital will be the number of bonus shares issued multiplied by the face value, which is the amount of stock dividend, 250,000. Here also, we have the cash dividend of 250,000. The amount of dividend is same, only the method of distribution. There cash dividend, here stock dividend. So what happened to the financial statements? we can see that stock dividend will not have any effect on the cash flow statement, will not have any effect on the cash flow statement because stock dividend does not involve any outflow of cash. But what is this stock dividend? It's a distribution of profit. So other equity will reduce to that extent. All other things remaining same, no dividend in the form of cash, but there is an increase in the capital because of the bonus issue. We can see that the capital has gone up. But why did the capital go up? Because of the stock dividend. The capital has not gone up because the shares have been issued to the public, but the shares have been issued to the existing shareholders. And did the existing shareholders give money? No. It's a capitalization of profit. It's a distribution of profit. So therefore, in this case, the number of shares increase, whereas the reserves go down, but no change in the equity. That's important. But equity will not change, but the number of shares goes up. Therefore, we can see the book value per share has also changed or has decreased. But why did the book value per share decrease here? When there is no change in equity, the number of shares increase, therefore the book value per share has gone down. We know that the book value per share is equal to equity divided by number of shares. In case of cash dividend, the book value has decreased because the equity has come down. Because the equity has come down. Okay, because of the distribution of dividend. But in this case, the equity has not come down, but the number of shares have gone up. So in one case, the book value has reduced because the numerator equity has gone down, the denominator remaining same. Whereas in case of stock dividend, no change in the equity, but the number of shares gone up. So we can see that the impact of the decisions on the financial statements can be seen through by understanding the interrelationship. The financial statements which we have prepared here is not arbitrary. All these have been prepared keeping in mind or rather using the generally accepted accounting principle. But at any point of time, I strongly recommend you to see all the four financial statements together, observe the interrelationship, and identify and understand the impact of the business decisions. Thank you.